Selling stocks after a drop and never buying back leaves people working extra years because the savings they kept in cash stopped growing. The behavior is bailing out when prices fall and sitting on the sidelines waiting for certainty, or hunting for the next hot pick instead of owning the market. Financially, that means you lock in losses, miss the rebound, and your money earns little, while businesses you could have owned keep compounding without you. Picture checking your account after a bad headline, moving everything to cash for safety, and then watching the next months of gains happen while you tell yourself you will get back in later. A share of stock is a claim on a real business. You're not buying a number on a screen. You are buying a slice of the earnings, the assets, and the future cash the company will generate. That slice entitles you to whatever the board decides to pay out and whatever value builds inside the business as it grows. The market price moves because buyers and sellers update what they think those future cash flows are worth, not because the ticker wants to punish you. If the business improves over time, your claim tends to become more valuable. The stock market pays you in two basic ways. It pays you cash the company distributes to owners, and it raises the price others are willing to pay for your slice if the business grows its profits. Sometimes the business also reduces the number of slices through buybacks, which increases your share of the pie without you lifting a finger. There's also a third force that sneaks in: how optimistic or pessimistic the market feels about $1 of earnings. That mood swings, but over longer stretches, business results do more of the heavy lifting than mood. Think about a local coffee chain that has a loyal crowd every morning. It earns money on each cup, pays its staff, keeps the lights on, and the leftover profit belongs to owners. Some years it sends a portion of that profit out to shareholders, and some years it keeps more inside to open new locations or upgrade equipment. As those stores get busier and the company gets better at what it does, profit per share rises. Over time, the stock price tends to follow that rising profit, even though headlines, seasons, and temporary fads may throw it off the path for a while. The beginner mistake is thinking the price makes the money. They stare at charts, buy after a run because it feels safe, and sell at the first red day because it feels smart to take control. They treat every zig as insight and every zag as danger, and end up paying trading costs, widening the gap between price and value with their own reactions. What goes wrong is simple. They are managing feelings, not owning a business, and feelings are expensive to manage in a market that pays you for patience. The fix is to stop looking for excitement and start looking for earnings. Here's the correction if you do not want to analyze individual companies all day. Own the whole field cheaply and let the businesses work. A broad, low-cost index fund gives you tiny claims on thousands of companies, so you ride the aggregate growth of the economy. Keep turnover low, which just means stop churning your holdings for no reason. Turn on automatic reinvestment for any cash distributions so your money keeps buying more slices of productive assets. Set a simple target mix and stick to it when the headlines are loud. Dividends are the quiet workhorse that a lot of new investors ignore. A typical market payout is around 2%, and it does not look exciting when you're scanning for big moves, but it is steady cash that shows up even when the market is moody. If you reinvest that cash into more shares, your future payouts grow because you own more slices. That slow drip pushes your total return higher without you needing to guess what happens next. Skip reinvestment, and you leave earned fuel sitting in the tank. Price gains come from business growth, not magic. When companies reinvest profits into projects that actually earn more than their cost, your claim on future earnings increases. Sometimes they spend smart on new products, smarter processes, or better service, and the market wakes up later and reprices the stock higher to reflect stronger economics. Other times, the market wakes up too fast and gets ahead of the numbers, and then the price goes nowhere while the business catches up. The point is to anchor your expectations to cash generation, not gossip. Over long stretches, stocks have paid owners about 7% a year after inflation, and that is the core reason they beat cash and most bonds for long-term goals. That number is not a promise for any given year, and the path will try to shake you out. But owning productive assets that raise prices, cut costs, and sell more to a growing world has historically paid better than lending money or hoarding it. The market pays for waiting and participation, not for prediction. You earn that average by staying in your seat. What makes this work is compounding, which is just growth earning growth on itself. The first step is tiny and dull, but every step adds to the base for the next step. Pull returns out to time the market, and you cut the base right when it is starting to matter. Dump cash in only after a surge, and you pay more for the same slice you could have bought cheaper earlier. Compounding rewards the boring habit of showing up on schedule more than it rewards the clever hunch. Costs matter more than your instincts want to admit. A seemingly small ongoing charge, like an advisory or fund fee of 1%, does not feel like much in any single year, but over decades it quietly extracts a large share of what would have been yours. It clips the wings of compounding because every year starts from a lower base than it should. Layer trading costs on top, and you are fighting uphill while telling yourself you are getting help. Keep costs low so more of the engine's output stays in your account. You control costs by using simple building blocks and ignoring expensive packaging. Broad index funds with low expense ratios do the job of capturing business growth without the marketing spin. If you want advice, pay for clear, one-time planning rather than a forever skim of your assets for generic allocation. Monitor the total cost of your choices once a year and cut anything that does not prove its value. Your future self is not impressed by glossy brochures, only by what stayed invested and grew. Taxes are another drag that many new investors learn about the hard way. Trading often realizes gains that could have waited and been taxed less harshly, and it can generate short-term bills that show up even in years when your portfolio feels flat. Dividends can be taxed differently depending on how long you hold and what kind of account you use, and selling inside a tax-advantaged account versus a taxable account has very different consequences. The practical fix is boring. Hold longer, minimize turnover, and use tax-advantaged accounts for stock funds when you can. If you must trade, be deliberate about where and why. The other rookie move is trying to outsmart volatility each week. Jumping in and out based on headlines or gut feelings feels active, but most of the market's long-term gain is carried by a handful of very strong days that you only capture if you were already in. Missing even a few of those can leave you trailing far behind the outcome you thought you were chasing. It does not matter that you guessed right plenty of times if you miss the days that did the work. Time in the market beats timing the market because money is made while you are busy waiting. The antidote is mechanical, not mystical. Automate your contributions on a schedule and let orders run whether the news is cheerful or grim. This is called buying on a rhythm, and it keeps your average purchase price honest because you inevitably buy more shares when prices dip and fewer when prices surge. When you get a bonus or a lump sum, put it to work rather than drip feeding it forever while you wait for a perfect entry that never comes. Consistency is a strategy, and it outperforms charisma in the long run. Stocks are not for every dollar you have, and pretending otherwise is how people turn a good tool into a hazard. Money you will need soon does not belong in something that can jump around a lot in the short term. Set aside cash for near-term needs and an emergency buffer so you are not forced to sell stocks at bad times to cover life. Then decide how much of the rest goes into stock funds based on how long you can leave it alone and how you sleep when prices swing. Right-sizing the risk lets you stay invested long enough to let the engine work. Your job is not to forecast which company will triple next year. It is to capture the returns that businesses, in aggregate, generate as they sell real goods and services. A plain index fund and an automatic plan do that with no heroics required. As your income grows, raise your automatic contribution and keep reinvesting every payout. Rebalance once in a while to keep your mix in line without trying to guess the next turn. This clears the way for the single biggest lever you control: participation. The heart of this lesson is simple. The stock market makes you money by connecting your savings to the growing earnings of real businesses, and your results depend on staying invested, keeping costs and taxes low, and refusing to treat price swings as a to-do list. Focus on cash flows, not predictions. Own productive assets, automate your behavior, and let time, not drama, do the work. Next up is what is a 401k and why employer matching is free money, because the smartest place to apply this is inside the account where every match and tax break multiplies what the market is already doing for you.